You know the moment when your dashboard lights up, the engine sputters, and your heart sinks? We've all dreaded it. In this video, we'll first break down why a blown engine in a financed car is such a financial nightmare. Then pull back the curtain on a new subscription model that claims to erase that fear entirely. We'll explore how it works, whether it's worth it, and the hidden challenges no one's talking about. Stick around. By the end, you might see car ownership in an entirely new way. Before we move on, I would like you to subscribe to the channel and like the video. Around 1 in 5 cars bought on finance will suffer a major mechanical failure before the final payment is made. And when that failure is the engine, it isn't just a bad day. It can spiral into a nightmare that affects your bank account, your credit score, and even your legal standing. Imagine driving home from work, hearing an unfamiliar knock from under the bonnet, and 10 minutes later, your car cuts out completely. The breakdown truck arrives, the mechanic shakes his head, and you're told you need a replacement engine that costs as much as a small holiday abroad. Now, picture this happening while you still owe thousands of pounds on your finance agreement. The car sits motionless on your driveway, technically yours, but also partly owned by the bank. Missing your payments isn't an option if you want to keep your credit intact, but repairing it? That could mean emptying whatever savings you have or taking on more debt you can't afford. The problem isn't just the repair itself. It's how quickly it sets off a chain reaction. One missed installment can trigger late fees. Those fees make it harder to catch up. Your credit file takes a hit, making future borrowing more expensive. In the worst case, you could face repossession or even court action to recover the balance. Take the case of Sarah, who bought a 6-year-old hatchback on a finance deal. She still owed £5,000 when the timing belt failed and wrecked the engine. A replacement was quoted at £3,500. The car itself was now only worth about £2,000. Repairing it made no financial sense, but without a repair, she had no transport for work. Selling it would still leave her with most of the loan to repay, and stopping payments would destroy her credit. She ended up making her monthly £240 finance payments for more than a year on a vehicle she couldn't drive, simply to avoid the larger consequences. Research shows the average cost of a replacement engine in the UK falls between £2,500 and £4,000, depending on the model and whether the part is new or reconditioned. Spread over 36 or 48 months of finance payments, that sudden cost can feel impossible to absorb. And unlike a warranty-covered fault in the early days of ownership, lenders aren't interested in whether you can use the car, they just expect the agreed monthly amount. The stress goes beyond money. There's the pressure of juggling transport while paying for something that's now just an ornament. The fear every time an unknown number calls in case it's a collections agent. The feeling of being trapped in a deal you no longer want but can't escape without even greater losses. In some situations, the timing of the failure can change your legal options. Under the Consumer Rights Act 2015, buyers can reject a faulty vehicle within 30 days of purchase for a full refund. Between 30 days and 6 months, there's a presumption the fault was present at the time of sale, giving you a stronger claim for repair or replacement at the seller's expense. After that, proving the fault existed before you bought it becomes more difficult, and the cost responsibility shifts almost entirely to you. That's why so many people in Sarah's position simply keep making payments, not because it makes sense, but because the alternatives are just as punishing financially. But what if you could sidestep that risk altogether? Before it happens. In the same way you pay for phone protection or streaming services as a bundle, some companies think they've found a way to package protection for your engine into a simple monthly fee. Imagine if your engine failed tomorrow and you didn't have to think twice about how to pay for it. No scrambling for a loan, no weighing whether the car is even worth fixing. Just a call, a tow, and a solution that doesn't drain your savings. That's the pitch behind the idea of an engine subscription, where a set monthly fee covers major engine repairs, full replacements, or even swapping you into a different vehicle if the worst happens. At first, it sounds suspiciously like an extended warranty, the kind most people avoid because of fine print, exclusions, and endless claim disputes. But the subscription model is trying to work differently. Instead of a one-off package you buy upfront that starts degrading in value the moment your car gets older, this would run like a streaming service or a smartphone care plan. You pay as you go, everything stays active for as long as you're subscribed, and there's no sudden expiry date right before you actually need it. Other industries have already moved towards shifting risk away from the customer like this. Mobile phone insurance isn't about stopping your device from breaking. It's about making the fallout painless. Streaming replaced CDs and DVDs by delivering access without worrying about wear and tear. The same way you don't think about replacing a smashed phone screen because the repair's already baked into your plan, an engine subscription could mean you never have to face the full cost of mechanical failure. The scope could be surprisingly broad. Some plans being discussed would include not just the engine itself, but the installation work, pulling out a seized block, sourcing a replacement, and getting it fitted. If the replacement is a JDM import or a used unit from a specialist breaker, the subscription could cover the complexity and delays that come with it. That might mean factoring in the lead times for a rare engine, or ensuring you get a compatible part without paying a premium for fast sourcing. Coverage levels could vary. The most comprehensive might allow unlimited repairs during the subscription, guaranteeing a full replacement if the engine is beyond saving. In cases where the car is still on finance, some versions could even clear your outstanding loan instead of fixing the vehicle, letting you move on without being stuck making payments on something you can't drive. The real draw is predictability. Paying an extra £25 or £30 a month above your normal expenses is far easier to plan for than suddenly facing a £4,000 bill after a breakdown. For drivers already budgeting tightly, that shift from unknown and potentially devastating to small and constant can turn the prospect of ownership from stressful to manageable. Of course, there are limits. A plan like this might only be valid at approved garages or within certain regions. If you like using a specific mechanic, that may not be possible. Over several years, you might pay more in fees than you would have spent if your car never suffered a breakdown at all. And some drivers could see it as paying month after month for something they never use, which is the same criticism people level at phone insurance or extended coverage for electronics. A subscription won't stop engines from failing, but it changes what happens next. Instead of a sudden, unplanned bill that can wreck your budget, you'd know exactly what you'll pay each month, no matter what goes wrong. That kind of predictability has already changed how we consume music, films, and even phones. So, think about your own comfort level with car risk. Would the extra monthly cost be worth the peace of mind? Or would you rather take your chances and hope the breakdown never comes? Let me know. Would you pay to never fear a repair bill again?